For those of you that are with us live today, chances are pretty good that there's a lot of people listening to this on an archive at some point in the future. So I'd like you to welcome as well too to our class. This is one that I've been waiting a long time to give, and I think there's a lot of information here to help keep you on the right path to getting started in the right manner with trading intraday futures. Now again, guys, we bring this up every time with our standard disclosure is that you have to treat this like a business. Please treat this like a business. And everything you'll hear about from me is how to treat this like a business and not just going out there and blazing away in the open markets. If you don't treat this like a business, if you treat this like a hobby, it will be the most expensive hobby that you can possibly imagine. We don't want you to do that. Please don't distribute this material without our permission. It's that simple. And about TheoTrade, who we are and what we do is we're a trading education firm based out of Scottsdale, Arizona, specializing in options, futures, and stock education. We are veteran professional traders. We provide the best trading education in the business. Your results and ultimate responsibility are your own, however. Most of you guys know me by now. I'm a husband, father of 3 student pilots, still working on that student pilot thing, just very difficult to fly during the winter here. I am a reformed engineer. I used to be an engineer and I try not to be one anymore. I'm that guy that quit my job to trade full time, full of optimism, and boy did I get a face full of the market back in 2008. That was an exciting time to to go solo. So for TheoTrade for the past 2 years, coming up on April 1st, I'm the options, futures, technical analysis, and NLP, which is neuro-linguistic programming coach at TheoTrade. I like to be an innovator. I like to present things that everybody knows in maybe a different way that you haven't heard before. So I like to use a lot of graphics and visuals, as you might notice, because I think you'd be surprised to how much you already know. And that's my contention, is a lot of you already know a lot of things of what you need to know, and maybe my job is to be able to unlock that knowledge within you. So I've been trading with Thinkorswim for the past 12 years, and yes, I still have a book on Amazon called Hacking the Holy Grail. That is what it looks like. It's out there. Okay, that's who I am. Let's talk about what we're going to be doing today. What are futures contracts? Why should you bother trading them? What's wrong with stocks and options and things like that? What's the big deal with futures contracts? What about this trading framework thing? What is it? Why do we need it? Which futures contracts should we trade? What equipment do we need to trade futures? And how do we earn the right to trade live capital with these futures? And so I'm going to talk about my overall technical trading approach to futures. Now, some of you may be disappointed I'm not going to spend the next 3 hours going through every tick in the marketplace and showing you every chart and everything like that. Honestly, and I'm going to make this point several times, I really don't think that the mechanical approach that you pick has that much bearing on your overall success. And that's completely opposite to the way that most people attack this problem. So I will spend some time on my overall technical approach to futures. I just don't think it's that important. I will show you how to manage your trading risk. I will show you how to pursue continuous improvement of your system. And then I will show you how to adopt a professional trading mindset. And guess what? They're all kind of wrapped up together. And then we'll talk about scaling up, and then we'll take our final Q&A session at the end of the day. All right, let's get rolling here. If you've been watching markets lately, we have a lot more volatility to work with than previous years, right? We've had this very quiet market for a long period of time, really since the beginning of 2016, and especially after the Brexit, midway through 2016, it's been very quiet. We've had very low volatility. We've had very low implied volatility. So all the option sellers out there have been just dying. And then guess what? We've had a little bit of a break lately. We've seen more volatility recently. And my expectation is that this is going to be there going forward for quite some time. If you have the time to dedicate to this, these are some of the best conditions that you'll see for intraday trading. Why? Because on a typical day, you'll see something like this. Right now, the average true range of the Dow is doing 400 to 500 points. I mean, you might not see tremendously big candles, but what you're going to see is all this movement around here. You're going to see so much intraday movement. Whereas in the past, maybe like last summer or something like that, maybe you'd get one move a day, and all of a sudden you were getting 4, 5, 6 moves a day. There's significant moves. So it's a matter of how much you want to stay connected to the market during the day. So today's workshop is about showing you how to build a proven edge before doing so. There's nothing that quite matches this. I think this is very important. This sense of allure and what I call the siren song. You guys know what the siren song is, right? Trading futures contracts intraday. You guys have seen the videos, you know, and if you've had any experience in this, you know that you can make a day in the first 2, 3, 4 minutes. You're done. You can do one trade and you're done after about 3 minutes and you can even trade pre-market if you wanted to. And so that's very compelling. You can actually live, right? You can actually spend your day living and doing all the things that you want to do instead of sitting there being glued to the monitor with your rear end in a chair all day long, which is unhealthy for you. So that is the potential. That's the potential, and you all know that that's true. I don't have to sell you on that fact that there is so much potential for this type of trading. However, the knife cuts both ways, doesn't it? So I do want to talk about my experience with futures for a minute because I want you to understand that it's not all roses. It's not all perfect, right? So I started with this back in 2005. Same way as everybody else did. I originally started with options, right? So I was a successful options spread seller. I was doing so well with it that I quit my job and was trading from home, and I found out that actually when you quit your job, all of a sudden you quit your whole social system. So all of a sudden I no longer had a whole bunch of work buddies to hang out with. I no longer had a reason to leave the house anymore. All of those work friends that I had, all those lunches that we did, and then we do stuff on the weekends. So my whole social system just went out the door, and all of a sudden I'm like, it's just me and the dog. And frankly, I was bored. And I'm like, there's got to be something else that I can do. And then I stumbled into futures, and I said, wow, well, this is really cool. This is really exciting. I should be able to make more money intraday with this. It made sense. It made sense to find some other form of income that I could pursue during the day. And I'm already watching the S&P 500. Why can't I just do the same analysis on it that I'm doing already? So it all made sense to me. And this is a scary admission here. When I first started, I didn't know anything about the dome. I didn't know what a dome was. And so I would actually go into, imagine this, imagine going into the trade tab of your broker. And for every every futures trade that you wanted to place, you were actually buying or selling it using the same, imagine the same way that you enter an option, you would be doing it through. And so there was, 5 or 6 clicks just to generate a trade entry and then an exit. And it was kind of insane. And the only thing I think that saved me back then is the markets were barely moving at the time. Back in 2005, 2006, they were not moving very much at all. And that's why option selling was so good back then. So I really did not know what I was doing back then. But then eventually, it's like using a carrier pigeon or phoning your broker to enter a futures trade. That's how they used to do it. 30 years ago, they would phone their broker and say, okay, go long, go short, those kind of things. It's crazy, isn't it? Eventually, I caught on. I caught up, did a little studying, and said, got an interactive broker's account, and then I upgraded to TradeStation. And then a Dome, and I was set, right? Or at least I thought I was. It did seem easy, right? And that's the allure of this. Just get the price to move in your desired direction by a few ticks or a few points, and then your day done. It's really simple, right? But it's not easy. I continued to lose money as I gained experience. Just like 99.9% of the traders out there. So I did some silly things like we sold the family van, and instead of putting that into the equity for a new car that I would get, I would say, I'm going to keep this and I'm going to trade this. And that way I'm going to take this $8,000 and I'm going to turn it into something much bigger than that. Or at least that was the intent. And in retrospect, that was really stupid. Ultimately, as the volatility picked up, I blew out 2 accounts, 2008, 2009. Because we just had these unbelievable trend days. I get on the wrong side of the trend, and then I'd, quite honestly, you can lose your mind trading volatile days like this if you don't have control over yourself. Dome is depth of market, that's correct. So today, I can make a consistent, modest income trading futures intraday. I'm not going to brag about it. I'm just going to say I'm modestly successful with that. And that's really all I care about right now. Can it be more than that? Absolutely, it can be more than that. It can be whatever you want it to be. This is all I care to make it right now. So what did I learn in the meantime? What turned it around for me? How did I get from some dude blowing up accounts to being able to make a consistent income? That's what I want to share with you today. So this class that I'm giving today is brought to you with the spirit of, if I could go back in time and if I could talk to that dude and say, wait, can we go have a beer, a green beer? And this is what I would say to that person. All right, stop what you're doing right now. Follow this plan to the letter. So everybody wants to just focus on the mechanics of the system. Everybody just wants to know what the studies are. Hey, what chart, what time frame are you using on your chart? What color candlesticks are those? Mine look different. What's that color? How did you close that in? What kind of study are you using? This is what we all want to focus on. The instruments, the studies. Oh, the PC, you got a higher clock rate than mine. Maybe that's what I need. The broker. And we're going to spend a fair amount of time talking about these things today. But I would say the impact of all those elements pales in comparison to applying the right trading mindset to this approach. And those of you that have been around for a while, you know what I'm talking about. You know that this is true. I'd say it's at least 90% of the challenge. 90% of your results are specifically attributable to your mindset. And this is what took me and others so long to achieve profitability. So let's get into some ABCs here, and then I'll get into the structure of the day. Futures are regulated by the CFTC and NFA. So those of you that have ever been tagged with a pattern day trader, PDT rule, so if you've traded options or stocks, and if you do more than 3 turns in a week, all of a sudden, bam, you're a PDT, pattern day trader, and it's a real drag. If you're below 25,000. Now, if you're above 25,000, you'll still be tagged as a PDT, but it's sort of it's like a black eye that doesn't hurt, right? it's just for show. It's not going to affect you at all. But below 25,000, it is a real drag because they will not allow you to place another trade until the previous one cleared, those kind of things, and it is egregious. They're trying to protect you. That's what they're trying to do. That's the spirit, that's the intent. However, futures are regulated not by the SEC, but by these guys, and it's not the same thing. You can trade as many times as you want to with futures contracts. That's good and that's bad. So this gives you more freedom intraday, but it's a double-edged sword. isn't it? Futures are the ultimate directional instrument. They're very pure to trade. What do I mean by that? That means that they're very linear. So I know that if I have an S&P 500 contract, and if I go long one contract, and if it goes up by 1 point, if it goes up from, say, 2,800 to 2,801, I know that it's going to gain in value by $50. I know that. There's no guesswork. It's not like if you go long an option, you're not quite sure what you're going to get depending on where the implied volatility started or how long it took it to make that 1 point move. You could have burned a lot of time value off. So options have a lot of moving parts to them, don't they? And even to some degree, stocks have some issues too, like Friday's dividend, which got paid out. Okay, so lots of things to go. So futures are actually very pure. They really are the ultimate directional instrument. They're very, very nice to trade. There are far fewer traps to know to trade futures. When I first started learning about them, I'm like, okay, wait a minute. And I just finished learning all about options, or at least what I thought I knew all about options at that time, and trying to figure out all of those little, okay, if you're within a penny on expiration day, you're going to get assigned, or there's also if you're holding a short call contract around the time of the ex-dividend date. I mean, look, with options, you have so many little landmines that you have to look out for. You guys know that by now. And once you learn them, it's not that bad, right? You can kind of tiptoe around the landmines, and you can work yourself into some edge. And there's some more edge. But with futures, it's very simple. I kept asking when I was learning about futures, like, really, is that it? You're kidding. There's got to be something more than this, And there was the quarterly roll that you have to go through a roll, and there's the cost to carry and things like that you have to account for from time to time. But it's really no big deal. There's very few gotchas. So normally, this requires a margin in account and a signed agreement with your broker to trade. You can't just open up a cash account and boom, trade futures. You can't do it. You have to open up a separate agreement to trade futures with everybody that I've ever seen. The one change I've seen recently has been allowing futures to be traded within an IRA. That to me is a big change. So what I found is that most retail traders, and we are all retail traders, stumble into futures trading. And then they stumble right back out again because they weren't prepared for the arena. It does not have to be difficult. It does not have to be difficult. You just need to be prepared, go about this in a business-like fashion, and earn the right to get in the arena. I mean, in no other business do I know of where you can go from zero to major league, right? In baseball, if you're a baseball player, you can't just decide one day, I was really swinging it well down at the batting cage the other day. I was hitting that 90-mile-an-hour pitching machine. I think I'm ready for the pros. And you can't just do that. You can't just walk onto the field. You can't hit the big show without going through all the different farm leagues and proving yourself along the way. But as a retail trader, you can do that. You can go against the best in the world tomorrow. Well, Monday. Monday if you want. As long as you can fund your account, you've earned the right to be able to do that. And I think we all know how that's going to turn out, don't we? So you got to earn the right. You got to go about this in a business-like fashion. So the temptation of most traders is to major in the minor things. This is what we do. We try to control the things that we want to control or that we can control. What is that? Well, and I'm sure I'm going to be asked about this today. So let me warn you ahead of time. Don't ask me about taxes. Don't major in the minor things. Go create a tax problem and then solve it later. Go create a tax problem for yourself and then hire an expert to solve that for you. Don't ask me about commission rates today. Don't major in the minor things. Commission rates are not the most important thing for you to focus on right now. Getting good entries and managing risk is the important thing. Understanding how to work on your own mindset is the important thing. What techie features do you need in the dome? How many gigahertz is your clock rate on your PC? It doesn't matter that much. It doesn't matter that much. Don't major in the minor things that we all do. So none of that stuff is important if you cannot manage yourself. None of it. None of it's important if you can't manage yourself. So if you hear me say today, don't major in the minor things, you'll know what I'm talking about. So I'm a proponent of visuals. I'm a visual dude. So let's get started with today's framework for the class. So let's build these levels of skill. So you may have seen this framework before in a previous presentation. I like to, repetition is the mother of skill, right? So we're going to build things up in a pyramid format because a pyramid is ultimately the most stable structure that's out there, right? It's not going to move. It's not going to blow with the wind. So let's put a foundation in, and on top of the foundation we'll put in some process for research and development. And then from there we're going to add the element of Kaizen, which is a Japanese word for continuous improvement, right? Based on Deming. So Deming had to go over there and do that. And then we can focus on acceleration. So once we built a foundation for being able to trade, once we've done the research and development, once we've continuously improved to the point where we're actually throwing off a positive profit factor, then we can accelerate. It's kind of like getting a plane off the ground, right? It's kind of like getting a plane off the ground. You've got to do all your pre-flight work. You got to make sure there's fuel in the tanks, oil in the engine. You got to make sure all the systems are working. So that's your foundation. And then have you done all your pre-flight planning? Do you know where you're going? Is the weather going to support what your flight wants to do? And then you can start to do a takeoff roll. Can you get up in the air? Can you sustain some form of altitude? Right? Can you sustain some form of altitude? And then once you can sustain some altitude, you've got the speed up there, then you can start to really get some altitude. That's just where you can start to really make a big, big difference in what you're doing. So again, so many traders want to start from the backwards. They want to start up here and say, I want to go as fast as possible from day one. Well, that's great, but you can't do it while you're on the ground. You've got to get some altitude. You got to get some space above you. If you want to do aerobatics and things like that, you got to have altitude. So those are the levels of skill. This is the framework that we're going to be basing things on today. So as you'll see today, I love giving you guys a visual because, look, I've been through enough webinars myself. You're sitting there, okay, where are we? How much longer is this going to go on? So I always love to give people a visual for understanding where we are in the process. So we're just starting right now. We are just starting, but I promise it won't be that painful. So I want to go into contracts and markets to begin with. Contracts and markets. There are dozens of possible future contracts that you can trade. You can trade oil, natural gas, gold, silver, right? All different types of commodities. I'm a firm believer, though, in starting with the U.S. Index E-mini futures. Please start with this. Don't expand beyond this ability because of the fact that many of those contracts can be either illiquid, number one, or number two, have great amounts of leverage to them. Don't come back to me and say, hey, I'm getting beat up trading oil because you haven't earned the right to trade oil yet. So these have the following: the liquidity, the smaller leverage that we desire to get started with. As you gain experience, you can add heavier markets to your arsenal. But get good at these ones first before you think about going to other contracts. Earn the right to trade instruments with bigger leverage. So the four biggies here, coffee futures. The four biggies here are the ES, the S&P, the NQ, the Russell E-mini, and then the Dow E-mini. So the Dow is now an E-mini. It's no longer the mini Dow on the CBOT. Oh, I used to hate the Dow on the CBOT because all of a sudden the CBOT would from time to time just go down, and you'd be in a contract, and the exchange would go down. And what are you supposed to do with that? And so you're terrified. You're looking at, okay, how can I hedge this position by trading the diamonds or something like that? And you wouldn't, the exchange might not come back up again for another hour. And meanwhile, the market's moving. And they're not going to take any responsibility for that, for the difference. So now everything's pretty good. Everything's on the CME, and it doesn't go down. They do a good job of running these contracts. Okay. Those are the four that we're going to be dealing with. All feature more volume during the U.S. cash session. So that's the 9:30 Eastern Time to 4 o'clock closing bell. That's the cash session. These features, however, will start trading 6 p.m. Eastern Time. So tomorrow night, watch your charts. Watch them open up. It's always fun, especially if we have big news over the weekend. I love watching the futures open up Sunday night. It's a ball, especially when there's bad news. It's always fun. So they'll basically trade for 24 hours a day. During this period, they do have an occasional halt in there, which is only after the market's closed. So all night long, you can watch the European session open up. So there's people within TheoTrade that trade the European session on contracts like the ES. There's enough liquidity that it actually can work. So some trading possible in the after hours, particularly in the European session. How much leverage per contract do we have? Here's the big boy. The ES is the big boy here. 1250 minimum tick. And I'll show you what that means in a minute if you don't understand. So it's $50 a point. NASDAQ is $5 minimum tick, $20 per point. Okay. A little bit different, a little bit more granular. Russell is $5 minimum tick, $50 per point. So here's an example where they've really shaved down the minimum tick, but still the per point is just as much as with the S&P. So much more granular. The Russell's always been a more granular contract. And what I like about the new definition of this contract, the old TF used to be $100 per point. Now it's only $50 per point. So it used to be $10 per tick. And that was a little bit too much within a liquid index. And then we have the Dow E-mini, $5 minimum tick, $5 per point. Each point is a tick. Whereas on the Russell, the NASDAQ, and the S&P, the ticks are some combination of a fraction of a point. Now the big volume leader here is the ES, and that's followed by the NQ, and then the Dow, and then finally the Russell. So it starts to tail off as you go from the ES down to the NQ, and then the mini Dow, then the Russell. So the Russell's still the weak sister out there right now, but catching up quickly. And the reason why this seems to be like the Russell will just like go on a tear and then it goes nowhere for a period of time. And then it'll go on another tear and then it goes nowhere for a period of time. So the Russell right now is a little bit spastic. So again, let's get into this notion of ticks and price steps again. So what you'll see is on the ES, you'll actually see the actual granularity of something like the ES because each one of these is a quarter point. You can even see this like showing up as each one of these is a quarter point. And this is why I don't really like the charting of the ES so much, because you can see this sort of feathery type of action. It's not as granular as some of the other indices. So here's an example about how to figure the leverage here. This is an example of the YM. So here's the YM, here's an entry here, right there. So let's say we're entering at 11, 25 to 11. And we hold this long and we sell this out up here at 250. So how much do we make on this trade? Well, If we subtract 211 from 250, we find that that's 39 points, and each of those 39 points is worth $5. That's per contract $195. So if we had one contract, we'd make $195. If we had more than that, it's a linear extrapolation of that. Okay, you can also see here how the contracts are split up like this, where the ES will go quarter.
Here's what I found in your Gmail.
Oh, we have one of these phones that is being naughty. Just a second here, guys. Just got a new phone this last weekend, and has a tendency to start talking. Okay, so here's the ES. The ES, you can see each of these is a quarter point step. Now this is the mini. The actual pit traded contract has much more granularity than this. So the actual pit traded contract is actually 10 steps per point, like from 58 to 59, where the E-mini is broken into 4 steps per point. But the YM contract, there's no steps in between each point, so this one is much more granular, and it shows up on the chart. So something else I want to show you here is that there's lots of resting orders sitting on each price level of the ES. So look at this, there's 245 here, 226 here. So here's where the current price is right now. Let me clear this up here so you can see it. So the current price is right here. It's usually highlighted, just like here's the current price. And so you have offers above and bids below. Offers above, bids below. So all these orders are sitting there. And so what happens is, for the price to go up, all of these have to be cleared out. All of this overhead supply has to be chewed through one piece at a time. Now there's more volume out there, but what I find so many times when I traded the ES is the price might come up to a level like this, chew through part of that supply, and then fade back down again, unable to chew through that overhead supply. And if your limit order is there, you may or may not get filled. You may or may not get filled. The limit order actually has to trade through there to guarantee a fill. Sometimes you would get filled, others not, depending on where you are in line. Depending on where you are in line. Okay? Whereas with the YM, that's not a problem. It's usually not that hard to chew through these things, right? So you'll see the YM being a little bit more loose, whereas the ES tends to, it's tough to chew through these things. It's a little bit more difficult. So I found that trading the ES to be somewhat frustrating. Now the downside to this with the YM, the downside is that you can get slippage. Slippage. What slippage means, you may have heard this term before. Slippage means, let's say that I was going long here, and I had a stop loss down here, say for example. So that's my stop. My limit is up here, so here's my limit. This is where I want the price to go. Let's say instead that it goes down this way. Now a stop order is a market order. A stop order is a market order, so when the price comes down and touches 911, it's whatever the market is at that given millisecond. And so if this is a very quick move, I can lose a couple of points of slippage. So that is the downside of having a loose ladder with fewer resting orders on here, or having less liquidity. It's easier to get in and out of orders, but you will have more slippage. You'll have more slippage, okay? Now also charting different contracts, each of them has a slightly different look and feel to these. Now these are all tick charts. These are all tick charts that I use. So I want you to look at the difference between these. So the NQ and the ES you can somewhat see that sort of feathery look that I talk about, where you can see sort of the granularity here. You can see sort of the feathery look to these candles, whereas with the NQ it's a little bit more contiguous. It's all put together. And to me the YM looks just like the NQ, like this. Charts very well, and then you can see with the Russell we just don't have as much volume, not as much activity. So this is very much what you'll see, is that ES will throw off more candles. It tends to be a bit chunkier by how it looks, but you've got to be trading what you can see, right? You've got to be trading an instrument that makes sense to you. Okay, so what I want you to do, your number one step to success is to focus on one contract. Focus on one contract. It is easier to start with the NQ or the YM contract. It's just simply easier to start trading with the NQ or YM contract of the four. The ES is too large and too chunky for me. Each step is just such a big step, and $50 per point, $12.50 per step on there. I like a more granular contract. I like less risk per tick. I like having more handles to get on and off the trade. The Russell is improving, but it's easier to learn on the YM and the NQ. So I've traded both the YM and the NQ. I like them both. I like them both. So the YM is sometimes better to start with because there's so many handles to get on and off the bus with. Does that make sense? Right? You're never stuck waiting for a fill. Never difficult to get on board or off the trade. The NQ is great these days because the NASDAQ is leading the market. So experiment with simulated trading. Settle on one contract, please. Don't become a jack of all trades and a master of none. Okay, so I'm going to take a quick break for questions here. Quick break for questions before I get to the next session. This is not a bio break. The bio break will come near the top of the hour, probably after the next session here. Okay, any questions before I move on? So David is asking, Doc, when we talk about the European session on ES, what times are we talking about in terms of EST? I believe that the European session starts at somewhere like, let's see, we're now an hour forward, so we're 4 hours separated from GMT. So EST, something like 4 to 5 in the morning, EST is when the European session. Okay, sound is working. Try to refresh. Okay. Lost video. So some people have lost the video, and if you've lost this, don't worry about it because we'll always be able to. The archive will always be perfect for these things. Archive will always be perfect for these. Okay. Any other questions? What impact does large resting orders have on your trade decisions? Not really at this point. Jeb, sometimes I will see. So what Jeb is asking about is, as we go back to this page here, what if we have a large resting order? So like, what happens if I see like 500 up here? You know, if I'm going to be taking a long trade, if I want to take a long trade where the price wants to go up here and all of a sudden I go from 11 to 7 to 10 to all of a sudden there's 500 contracts up there. Well, boy, that's going to be a long time to chew through that overhead supply if I see something like that. So that would definitely affect if I see something like that's completely way out of whack. But the other thing that you'll see, Jeb, is that you'll see these things move around a lot. You'll see these things move around a lot. They don't tend to sit in one space. All of a sudden, as the price moves up here, all of a sudden you'll see that 500 move up to here. It's like, wait a minute. And that's one of the issues that some people will have is that, hey, you guys are putting fake orders out there or things like that. I tend not to look that much at these. I tend not to look that much at these. I don't think this is really giving me that much information, but if I did see a huge resting order out there, it would certainly catch my attention. Okay, so let's see. Sheriff is asking, didn't get the tick or price relationship, okay? Let's just look at one of these. Just look at one of these, Sheriff. Okay, if I wanted to go long on the YM, if I wanted to go long on the YM and my entry here was 211, so I entered long at 211 and I exited up here. So the trade went in my direction, everything was great, and I decided to exit up here at 20. So that's 39 ticks. Okay, and as we know, so there's 39 ticks, and the YM equals $5 per tick. And so that is $195 gross profit on the trade. That's per contract. James, we are not going to talk about ag futures today. We are only going to talk about these four. So that's why I spent so much time going over the fact that we were going to be just trading and looking at the four major U.S. index futures markets. Not going to be talking about ag futures. Arthur. Let's see. Well, okay, let me catch up to somebody. Do I ever trade Sunday afternoon? No, I do not. TD, why do my candles on my charts move for about the next hour after the futures market closes? Well, the futures market's still open if it's still moving. Arthur, New York, using a buy stop instead of a limit order. Is that preferred to ensure getting a fill, slippage, or not? I will go over the different types of orders, Arthur. Ashada, during pre-market, is there any time we should avoid trading like the last hour before the market close? Well, that's not pre-market. Is there any time we should avoid trading? I like trading in the first hour. I think during the noon time is usually when it gets real slow and choppy. And then lately in today's market, we're getting some good action in the last hour. What about tick size per futures contract chart? So how many points are there per tick in the YM? That's one. Okay, so let's go back to this again. $5 minimum tick, $5 per point. You can't get any smaller than that. Russell's $5 minimum tick, $50 per point. If you want me to, what I can do is at the next break we can go over to the dome and we can show the difference between those two. The continuous contract is just for charting, just so that you have a daily chart that all glues together instead of looking at the different charts. Okay, last question, and then we got to move on here, guys. Deb, if you saw overnight that there was a huge crash in European stocks, would you sell a future before then in the regular market open? No, that's not what I do. You could. I'm not saying that you can't, but that's not what we're here to talk about today. I'm talking about looking for different setups and edge on one of these four contracts. Okay, guys, if you have further questions or if I was not able to answer your questions, please submit them at the next break or through emails, just fine as well too. If there's things that you don't quite understand or if I have to just dance over here today, again, there's limited time. We don't want this to take 5 hours. Let's get into the framework now. The bonus materials for this class included the program Building an Intraday Framework. That was a 5-video series. I hope you got the chance to look at it. I will briefly refer to it here. This is what I consider to be one of the most important points of this class here. Constantly, I will refer to it through today's program. The framework gives us the structure that we can use to succeed. All right, so you'll see me refer to this continuous cycle all the time. Most retail traders do not use a framework to manage their trading. Their corrective measure, so this is how we're supposed to use this thing. We're supposed to identify goals, the goals we start with. We put them into the market through rules. We get some kind of results through our trades. And then this is the correction that we make. Well, the correction is, well, this strategy is no good. I've lost 2 in a row. I'm going to try a new strategy. I'm going to buy it from a different vendor. I'm going to try a different indicator. I'm going to try a different study. I'm going to try a different contract. We don't give it any time to make corrections, to really dig into the meat of this. You have lots of opportunity to improve. You must embrace every losing trade for the opportunity to discover something. Most of us don't have the patience to do that. And you've got to be really honest with yourself. If you don't have the patience to do this, if you don't have the patience to dig and understand what's happening, why you lost that trade, what's the root cause to it, this is going to be a very frustrating exercise for you. You've got to want to pursue this. So the intraday trading framework, this is kind of the nutshell of what we're talking about here. A business plan specific to that strategy. Trading plan specific to that strategy. Journaling collection, and then using Pareto analysis. You guys have heard of the 80-20 rule, right? So again, this was brought up in not only the bonus program that you guys received, which was the trading framework, but was also in the Plan or Get Slaughtered class that's part of the bonus material for this as well too. So those of you that are older members, have been around for a while, you guys know my Plan or Get Slaughtered class, right? You've heard about Pareto analysis. So Pareto analysis allows you to say, okay, so here was my number 1 error. This one made the biggest impact to my trading results. Here was the number 2 error. Here's the number 3 error that I saw with my trading. Maybe I should just focus on this one first and not try to fix everything at once. That's what Pareto analysis is about. Understanding the root cause. So this is a challenge for a lot of people, understanding the root cause. I asked them, well, you lost a trade. What was the root cause? Well, I don't know. I lost money. Well, look, losing money is part of the outcome. It's not the root cause. You know, why'd you lose money on the trade? Well, I don't know, because I lost the trade. You got to dig deeper than that. Perhaps it was something where you didn't anticipate the energy. Perhaps you traded over an economic announcement and didn't anticipate the volatility that came from that because you hadn't done your homework to know that an announcement was planned at 10:30 this morning. Feedback loop in the next series of trades. What I want you to be able to do is, any system, this is what we do, guys. We stick money or dollars or pounds or whatever have you into this trading system. So here's this trading system that we use. And then what we hope for is out of that system comes a little bit more money. This is what we're looking for. But with anything else, we need to have some kind of a feedback loop to say, here's something you might want to consider before you take your next trade. That's what the feedback loop is about. We need to do that constantly to learn from these trades. It's a continuous learning loop. It's a continuous learning loop for these. So constant monitoring and evaluation. Does the business make money? I should be able to walk up to you if you come to Scottsdale and say to you, what's your win rate? What's your profit factor? And you got to have those numbers at the top of your head. Well, last month it was 1.6. This month it's 1.7. Excellent. You're doing great. If you don't know why you're losing the trades, why not? What needs to be changed? With most people, again, the depth of discernment ends up being, well, the strategy's no good. Or, I hate this contract. I want to try a different contract. It's the contract's fault. It's the market's fault. It's Ben Bernanke. It's Janet Yellen. It's Jerome Powell. Those are not things that you can change. You've got to find things that you can change. So remember, for most of you, you are your own performance coach. And this is something that got drilled into me through the readings I've done through Brett Steenbarger. This guy is a professional performance coach that works with a trading firm. This is all he does. That's his full-time job, apart from writing an occasional book, is he's a performance coach. So he visits with every single trader and says, okay, I know what your performance was last month. I know what it is this month. Let's see if we can figure out why it's gone down a little bit, because we need it to be up. Because if it's not up, you don't make as much money and the firm doesn't make as much money. That's what this guy's job is. You don't have that. We don't have the luxury of having a performance coach. Guess what? You've got to be your own performance coach. And it's not good enough just to borrow someone else's strategy. That's not the same thing. That's totally different. So I'm going to go through this briefly here. This is just a sample business plan for my YM trading. So I'm trading the YM contract. The trading plan is separate. Here's the funding for it. Here's stage one. Stage one, in my world, is a little bit different than how I'm going to discuss it in this plan or in this program today. So stage one is that I want to maintain at least a 1.5 profit factor. Now, if you don't know what that is, we'll get to that later on in this program today. With approximately a 70% win rate. These are the numbers that I have to maintain to stay in this stage. Okay, so we're talking about I'm maintaining a equity of at least $10,000 per contract because I don't know what the margin's going to be on any one particular day. From what I understand, through the recent volatility that we've seen, we've had a little bump up in volatility. So I never want to be capital constrained. I never want the broker to make a decision for me to rip away my contracts in the middle of a trade. It's happened before. All of a sudden, you reach a point where you can't maintain margin on the trade, they will shut it down. That's not very much fun. All right, so this is just my business plan here. There's stage one. I will trade 2 contracts for the majority of stage 1 trading, with the exception of extreme volatility days where I will do the single contract slim pickings trades. So I've done a few of those lately. Just because we have such wild volatility, I have to go down to 1 contract and set up with a much wider bracket. So stage 2, I actually will accelerate into stage 2 trading. And this is where I will use the dynamic money management that I'm going to talk about at the end of today's session. And then I talk about goals and cash withdrawals. So once I hit my monthly goal, what I will do is I will withdraw 40% of the net profits to my bank account. So I've got it all here. I mean, this is not like written up and stored on a shelf and becomes shelfware. This is where most business plans are sitting with people. Okay, plan maintenance. Every trade must be documented on Evernote via screenshot. And I want to spend at least 15 minutes in the pre-market every day taking trades off of my replay simulator. This is my business. This is my YM trading business. Is it the one that you should use? No, probably not. You want to do something a little bit different. You want to build your own plan behind this. If you build your own plan, then you internalize it. Okay, so I will cover a version of the trading plan when we get into the trading strategy itself in an upcoming session. Okay, here is journaling and monitoring. So what I will do is in the trading plan, I have a couple of different types of setups here, and then here's just different metrics of how to implement the trade. So these are more of just the trading rules that I have. Like, am I on the correct side of the 89? Is this the first entry that I could possibly take, or am I chasing this thing? Am I trading with the anchor swing, or am I anticipating things, or am I seeing something that wasn't there? Is my runner stop too tight? So I want to track all of these elements. And again, This is well documented in both the Plan or Get Slaughtered program as well as the Intraday framework class. So I'm not going to go too much into detail of this. You will get this spreadsheet. And then I want to track things like winds and maximum adverse excursion. So how many points of heat did I take on a trade? How far did it go against me? How far did it go for me? Here's maximum favorable excursion. What's the ratio of that? I want a big ratio like this one here. This one went 188 points in my favor and only 1 point against me. I wish I could have one of those every single day. And then finally, what's the results? And then here's the maximum. Here's the top line results. Gross wins, losses, profit factor, those kind of things. So I have all my results right here. I know what I'm doing with it. I can track everything from it and then make decisions based on this. So again, most traders don't give the process enough time. They don't give it enough repetition. They don't put the practice in to create mastery in their trading. Building this trading framework sets the guidance for these steps to success. I will take some questions here for this section, and then we will take a quick bio break here right after that. What's NinjaTrader? There you go. NinjaTrader is a free platform that you can download. I will show it to you later. Okay, any questions here before we take a bio break? Or is everybody sprinting to the bathroom right now? Okay, last call for questions before the bio break. Why Ninja? It doesn't matter. I'm not religious about any particular tool. It's the one I'm familiar with. There's probably other tools that you could use as well too. Is my journaling automated? No, it's probably a lot more manual than it needs to be, James. Remember, I am a reformed engineer, so I knew enough to be dangerous, but I was never good enough to be a real engineer or a programmer or anything like that. I lack the patience to be able to do that. So a lot of the stuff I do is very manual. And if you, I do have a lot of people that take my tools, they take the spirit of my tools, and then they automate the living daylights out of them, and because that's what they do. But again, I want to major, I don't want to major in minor things. Yes, you can just think with think or swim, although you certainly can. I find the replay a little bit difficult to operate with that, so you can make up your own mind on that. Again, I am not going to get religious about any one particular thing. That's one thing I refuse to get caught up in this program. Like a lot of people just get so into one brand or another that they get blinded to it, that brand allegiance. I try to use the best tool that gets the job done for me. Stuart, I'll get into that question later on because I think you'll see the difference. How much time do I spend in journal and preparation? I may spend maybe 5 minutes per trade in journaling. That's it. Yes, I use the same kind of spreadsheet for options trades too. Everything gets the same treatment. Do you need an account at Ninja? No, you don't. It doesn't really differ from an options plan, Roger. So there's a lot of questions saying, hey, how much different is this than options? It's a different trading plan, so it has to be different from an options plan, but the spirit is exactly the same. Okay, guys, let's do this. Let's take a break here. I'm going to be coming back. I'm going to be returning at, let's make it, let's give ourselves about 5 minutes here. So let's say 10:15 Central Time. So I'm going to be returning at 10:15 Central Time. I'm going to be taking